$50,000 an ounce. That's the number 2 billionaires can't stop talking about. Right now, 3 out of every 4 professional money managers in the United States are sitting at 0% gold allocation. 0. While they've been sitting on the sidelines, gold just did something it hasn't done in years. It broke its 200-day moving average, shattered a multi-month downtrend, and posted back-to-back weeks of buying so aggressive that even the trend-following algorithms can't ignore it. I'm Kenji Sinclair, and tonight 2 of the most connected men in the history of precious metals, a billionaire dealmaker and a forecaster who once refused to hand his own government a computer model, are both independently pointing to the same number, $50,000 an ounce. They're calling it inevitable. But before you get excited, there's a problem. The same chart that's screaming bull market is also flashing 2 specific warning signs. And if you don't know what they are, the next few weeks could shake you out of this trade right before it goes higher. Here's what you're getting in the next few minutes. First, the hard technical proof that this rally is not a dead cat bounce. Second, the 2 specific dangers that could trigger a short-term correction, and exactly where I expect gold to land before it turns back up. And third, the actual math behind that $50,000 number, so you can decide for yourself whether it's a fantasy or a forecast. Let's start with proof, not opinion. On the daily chart, gold didn't just drift higher this August. It broke a long-term downtrend and punched clean through its 200-day moving average, the line technicians use to separate a real trend from noise. On the weekly chart, the picture is even more convincing. The RSI, the momentum gauge, is nowhere near overbought. Gold reclaimed its 50-week moving average, the same level that has historically marked the entry point into every major leg of this bull market. The size of the green weekly candles right now dwarfs anything printed during the entire summer sell-off. And here's the part retail investors keep missing. The most recent survey of money managers and family offices in the United States found 75% reporting 0 allocation to gold, not underweight, 0. Those institutions are now watching the dollar weaken and the bond market wobble, and they're being forced to chase a market they've ignored for years. That is not how a bear market rally behaves. That is the early innings of institutional buying. So if the bull case is this strong, why am I about to tell you gold could still drop from here? Because 2 specific forces are about to collide, and almost nobody trading this move sees them coming. Warning number 1 is the dollar. On the weekly chart, the dollar index looks broken. Below its 200-week average, a confirmed double top, an uptrend snapped clean in half. But on the daily chart, the dollar is now sitting deep in oversold territory, and the last 2 trading sessions look almost identical. The signature of intervention. Someone, somewhere is defending this currency. That sets up a short-term relief rally, and because so many traders are short the dollar right now, that relief rally could turn into a short squeeze. Nobody knows exactly how violent it gets. But a stronger dollar, even temporarily, pulls fast money straight out of gold. Warning number 2 is one almost no one is talking about: oil. Crude has spent months fighting a long-term downtrend that now looks like it's finally breaking. If oil breaks out toward the 90s, it doesn't just move energy stocks. It revives the inflation conversation, and historically oil and gold have moved in opposite directions during exactly this kind of setup. A dollar short squeeze plus an oil-driven inflation scare is precisely the cocktail that could hand gold its first real pullback since this rally began. So how deep could it go? The moderate scenario is a retest of the low $4,600 to $4,400 zone. If selling gets more aggressive, which would likely require an actual shock in the stock market, the deeper zone sits closer to $4,200 to $4,215, right around the 50-day moving average. Neither of those levels breaks the bull market. Both are exactly the kind of pullback that gets bought. And that word, bought, is the entire key to understanding what happens next. Because of one story almost nobody in financial media tells you properly. Martin Armstrong spent decades building a computer model designed to find one thing: the turning points where confidence in a system breaks. He refused to hand that model over to his own government during an investigation, and the legal fight that followed put him in prison for years. Whatever you think of that story, the world's biggest hedge funds, corporations, and governments have spent decades trying to know what his model sees. Armstrong's answer is almost never talked about the right way. He doesn't say government debt collapses because it's too big. Debt just rolls over. Old bonds mature, new ones get issued over and over for decades. The real danger isn't the size of the debt. It's the moment investors stop asking how much a government owes and start asking whether they still want to keep financing it. We already saw a preview of that this year. When the yen came under pressure, the United States quietly stepped in and used euros to buy yen by the billions, because a wave of Japanese selling of U.S. treasuries was the one outcome nobody could afford. That's not one country's debt problem anymore. It's global and interconnected. And Armstrong believes confidence in sovereign debt is going to get harder to take for granted with every year that passes between now and the early 2030s. That's exactly why central banks are buying gold at a record pace right now. Not because they expect inflation to spike next quarter, but because gold is the one asset that doesn't depend on anyone else's promise. Money, Armstrong says, doesn't disappear when confidence breaks. It moves. And for a very long time, one of the places it has always moved to is gold. Which brings us to the number that's actually shocked the entire gold market this year. Because one billionaire didn't just say gold goes higher, he said $50,000 an ounce is inevitable, and he gave 5 specific reasons why. Thomas Kaplan isn't a random voice. He's a proven dealmaker in the minerals industry, the chairman of a major gold development company, and a billionaire who has built his entire career on precious metals calls. When he says gold is going 10 times higher to a range of $30,000 to $50,000 an ounce, the market listens, even when it doesn't want to. Kaplan lays out 5 reasons. 1. The United States has now crossed $40 trillion in sovereign debt, compounding faster than the economy can grow around it. 2. As that debt burden grows, fiat currency loses purchasing power, because a government under that kind of pressure has every incentive to inflate its way out. 3. Central banks see this coming, which is exactly why they're accumulating gold at a record, unprecedented pace. 4. Gold is finite. It cannot be printed, minted, or conjured into existence the way a dollar can. And 5. When trust in the fiat system finally breaks, capital has nowhere else proven to go but hard, physical assets. Put those 5 forces together, and Kaplan calls the outcome inevitable. Here's the part Kaplan never gave you, a time frame. So let's stress test it ourselves. To go from today's price to $50,000 in 5 years would require a compounding annual growth rate near 60%, sustained, without a single bad year. Not realistic. Stretch the same move out to 10 years, and the required growth rate drops to roughly 26% a year. Stretch it to 30 years, and it falls to about 8% annually, a number gold has matched or beaten many times across history. The honest conclusion isn't whether $50,000 gold happens. It's a question of when, and whether the world experiences the kind of confidence collapse in fiat currency that both Kaplan and Armstrong are independently describing. Let's make this real. Imagine a household carrying $40 trillion of debt. Obviously, nobody does personally, but stay with the ratio. That household can't pay down the balance. It can only make the minimum payment by opening a new credit card to cover the interest on the old one. For years, that works. The mailman keeps delivering new cards, the bills keep getting paid, and nothing on the surface looks wrong. Until one day, a bank decides not to renew the credit line. Suddenly, the size of the debt was never the real problem. The problem was liquidity, whether anyone would still lend. That's the entire U.S. Treasury market in one image, and it's exactly why the technical correction we talked about earlier doesn't change the underlying story. A short-term pullback to the low 4400s, or even down toward 4200, isn't the credit card getting canceled. It's a pause, a chance for the market to catch its breath before the underlying math reasserts itself. In every bull market gold has ever had, corrections like this one have been the entry point, not the exit. So here's the verdict. The bull case for gold is not a story, it's a chart. Confirmed breakouts, institutions still sitting at zero allocation, central banks buying at a record pace. The correction case is real too. A dollar short squeeze and a possible oil-driven inflation scare could knock gold back toward 4,400, or in a rougher scenario, 4,200, before it turns higher again. And the $50,000 number from Thomas Kaplan, backed by the same debt and confidence framework Martin Armstrong has spent decades building his career on, isn't a fantasy. It's a question of time, not truth. My take? Don't chase this rally, and don't panic if it corrects. Use short-term weakness to build a position in physical metal or quality mining names. And think in years, not weeks. This isn't about getting rich by Friday. It's about owning the one asset that doesn't need anyone else's promise to still be worth something 10 years from now. I'm Kenji Sinclair. If you want to see exactly how central bank gold buying and the last gold confiscation loophole connect to everything I just told you, that video is linked right here. Stay sharp, stay positioned, and I'll see you in the next one.